Welcome to the deep dive. So if you're like most people, your financial planning probably gravitates towards the big hitters, right?
Retirement, investments, that sort of thing.
Exactly, and long-term protection like life assurance. But today, we are zooming in on something that underpins all of it. It's that protective layer that stops everything from falling apart when disaster strikes right now. We're talking about general insurance, or GI.
And it really is the absolute cornerstone of a household's financial resilience. Our source material for today, which is just packed with insights, makes it really clear. GI is often, undervalued.
Just because it doesn't have that big, dramatic, long-term feel to it.
That's it. So our mission today is to pull it into the spotlight. We need to understand the principles behind it, the key product pitfalls, and what it actually means to be properly covered against those short-term shocks.
And the ones that cause immediate, massive disruption. Okay, let's unpack this right away then. Let's define the territory here. We're talking about immediate practical protection. So how does general insurance fundamentally differ from, say, critical illness cover, which also pays out for a big event?
Well, the difference is all about the contract length and the objective. A critical illness policy might run for 30 years. It's a long-term contract.
Right.
General insurance, on the other hand, it operates on these short-term renewable contracts, usually just 12 months, and its goal is strictly to protect the assets you already have. Things like fire, theft, damage. It's not about protecting your future income or creating wealth.
So it's about stopping a bad financial event from becoming, well, financially devastating today.
Exactly.
Okay, so we're talking about all those annual renewals. Home, car, landlord policies.
Travel insurance, private medical insurance, or PMI. It all fits in this category.
Right, it's the stuff that lets life carry on without a complete derailment if, your basement floods.
Precisely. And understanding all of these policies, it really hinges on mastering 3 foundational principles that are pretty unique to the GI world.
Okay, let's start with the big one. The core mechanism that really defines this whole sector. Indemnity. We're calling this the anti-profit rule.
Yeah, the principle of indemnity is, on the surface, straightforward. The policy has to restore you to the financial position you were in immediately before the loss happened.
And no better.
And no better. It exists purely to stop you from gaining financially from a loss. You can't insure your old car for double its market value, have it stolen, and then expect to walk away richer.
This is such a crucial distinction. It's a total move away from those defined lump sums you see in life insurance. So if I have an item that's damaged, how does the insurer decide what indemnity actually looks like in practice?
It happens in one of 3 ways: repair, replacement, or reimbursement. Now, this is where the policy details really, really matter, because the insurer has to factor in depreciation, unless you have a specific new for old replacement policy.
Okay, so if my 3-year-old laptop gets stolen, the insurer is what theoretically only required to pay me the value of a used 3-year-old laptop.
In theory, yes, the depreciated value.
Wait, hold on. Let's take that further. If my 10-year-old washing machine breaks and they only compensate me for its depreciated value, I might not be able to buy a replacement. You can't really go out and buy a used 10-year-old washing machine for that price. Doesn't that mean I'm not actually fully indemnified?
That's a really powerful point, and it's exactly why you have to read the policy details. In a lot of modern contents policies, insurers now offer new for old replacement, which bypasses that depreciation issue.
Oh. Yeah.
So they ensure you can replace the item with a new equivalent, but you have to check that that level of cover is actually included.
And if it's not?
If it's not, then the standard indemnity rules apply, and yeah, you might get less than the cost of a new replacement, because the principle is focused on the value of the item you lost, not the cost of its replacement.
Wow. That distinction alone just shows why reading the policy wording is so important. Okay, let's move to principle 2, insurable interest.
This one is really a necessity. It's about ethical practice. The client has to stand to suffer a legitimate financial loss if the insured event happens. You need to have a financial stake in it.
So you can't insure your neighbor's mansion or your colleague's fancy sports car.
Exactly. You insure things where your wallet is the one that takes the hit.
Makes perfect sense. It controls the risk and prevents what's called moral hazard, right?
Right.
Stops people from benefiting from events they might encourage.
That's it. And the final and maybe the most critical principle for the client's experience is utmost good faith.
This is the disclosure requirement, isn't it? Where you have to be completely honest about everything.
It is, and it's a reciprocal duty, but the burden on the client is heavy. You have to disclose all material facts accurately. And what's a material fact? Well, it's anything that could influence the insurer's decision to accept the risk or set the price.
So that covers everything from previous claims you've made, to what your roof is made of, to the security system you have installed.
All of it.
And this is where the disappointment usually strikes, isn't it? A client has a claim, the insurer investigates, and they find a non-disclosure. Let's say they had 2 burglaries 5 years ago they never claimed for, or they installed a security system but didn't mention it was faulty. What happens then?
The insurer is entitled to review the entire contract based on that non-disclosure. If that undisclosed fact materially increased the risk, the claim can be reduced or declined entirely.
And our sources confirm this is one of the most common reasons for claims being rejected.
It is. Honesty isn't just a moral duty here. It's a contractual necessity that literally determines if your cover is valid or not.
The lesson is so clear. When in doubt, just disclose it. Better to pay a slightly higher premium than to have your claim thrown out.
Absolutely. The devil really is in the detail of that application form.
Okay, let's switch gears a bit and talk about the mechanics of the policy, the fine print that affects the actual payout. We need to talk about excesses.
Right, the excess. It's the first part of any claim that you, the client, are obligated to pay yourself. So if you have a £500 excess on a policy and the damage costs £2,000 to fix, the insurer only pays £1,500. You absorb the rest.
And the purpose of that is twofold, right? It keeps premiums lower, and it stops people from claiming for every tiny little thing.
Correct. It keeps admin costs down, which in theory benefits all policyholders through lower base rates. You'll often have a standard excess and then maybe a much higher voluntary excess if you chose that to get a cheaper premium.
We also have limits and exclusions. How should someone approach reading these sections?
Well, limits are the maximum payouts. For content insurance, this often applies to high-value stuff like jewelry, art, or watches. If the general limit for a single item is, say, £1,000 and you have a £5,000 watch, you need to specify that item separately and pay a bit more to make sure it's fully covered.
And exclusions are the things the policy just flat out says it will not cover, no matter what.
Crucially, yes. Exclusions are what shatter that illusion that comprehensive cover means covers everything.
I see.
Standard exclusions might be certain types of flooding, general wear and tear, or, damage caused by pests. If you live in an area prone to subsidence, for example, you have to check if that specific risk is excluded or needs an expensive add-on.
Misunderstandings about exclusions must be the main source of disputes.
They absolutely are.
Okay, let's move on to most common products. Household insurance. So, buildings and contents.
So, buildings insurance protects the physical structure. The bricks, the roof, the walls, and anything permanently fixed to it, like your kitchen or bathroom.
And that's mandatory if you have a mortgage.
It is. Contents insurance is, well, everything else. All the stuff you'd take with you if you moved house.
And this brings us right back to that indemnity principle and probably the biggest pitfall in the whole GI world, the underinsurance trap. This is where people just guess the value of their risk and end up paying for it, literally, later on.
It happens all the time, and it is a costly error. When insuring a home, people often confuse the property's market value, what it would sell for, with its rebuilding cost.
Which is the cost of labor and materials to reconstruct it from scratch.
Exactly. The market value includes the land, the rebuilding cost does not. People grossly underestimate the rebuilding costs.
And if they estimate too low, that triggers the really technical but financially devastating average clause. Could you explain how that works in practice for our listener?
Sure. The average clause basically assumes that if you declare a value that's way lower than the true replacement cost, you are choosing to hold on to a share of the risk yourself. So let's use the classic example. Your home's true rebuilding cost is £300,000, but you only insured it for £200,000.
Okay, so you're underinsured by 1/3.
You are. So now let's say a partial loss happens. A fire causes £90,000 worth of damage. What does the insurer pay?
You'd think they'd pay the full £90,000 because it's way under the £200,000 you're insured for.
That's what you'd think. But they apply that ratio. Since you were only covering 2/3 of the total risk, they will only pay 2/3 of your £90,000 loss.
Which is £60,000.
£60,000. You are left responsible for the other £30,000. That's the sting. It doesn't matter that the damage was below your cover limit. They treat you as a co-insurer for the bit you failed to cover.
That is a staggering lesson in the difference between being insured and being adequately insured. It's not about guessing.
No, not at all. Accuracy prevents ruin.
Let's talk motor insurance. Yeah. Beyond the legal requirement to have at least third-party cover, What should people prioritize when they're scrolling through endless comparison sites?
They should stop prioritizing price exclusively.
Easier said than done.
It is, but comparison sites are great for seeing lots of options, but they often strip out crucial features to get that low headline price. You have to look at the details. What's the claim service like? Do they guarantee a courtesy car if yours is stolen, not just in for repair? What are the limits for personal belongings in the car?
I see so many people just click the cheapest option and then they realize that the high voluntary excess or the lack of features makes the policy almost unusable for smaller incidents.
Exactly that. That small saving on the premium can result in a massive out-of-pocket cost when you actually need to make a claim. True value is a balance of cost and practical use.
And travel insurance. We touched on it, but let's hammer home that medical disclosure point.
Yeah.
Because travel is where the financial stakes can get astronomically high very fast.
The risk of non-disclosure is absolutely critical here. The main purpose of travel insurance financially is to cover medical bills abroad, and those can run into hundreds of thousands of pounds.
Or more.
Or more. If you fail to disclose a pre-existing medical condition and you have an emergency related to it, the whole medical claim is invalid.
Even if you have something that seems minor, like high blood pressure, you have to declare it.
You must. And a practical tip for everyone. Get your travel cover the moment you book the trip, not the day before you fly.
Why is that?
Because the cancellation benefits, which cover you if you get sick and can't go, they apply immediately from the moment you buy the policy.
That's a great tip. Okay, let's broaden the view and place general insurance within the whole financial ecosystem. Private medical insurance, PMI, is a key part of this. What are its main benefits?
PMI really provides speed, choice, and comfort. It gives you faster access to specialists, it cuts waiting times for non-emergency procedures, and lets you choose your consultant and where you get treated. It's about well-being.
And minimizing the stress and time lost to illness.
Fundamentally, yes.
But informed clients need to know what they are not buying with PMI. It gets confused with long-term protection a lot.
It does. It's so vital to manage those expectations. PMI is not a substitute for income protection. It won't replace your salary if you're off work for 6 months.
Okay.
And it is not critical illness cover. It pays for the treatment. It doesn't give you a lump sum to restructure your life after a major diagnosis.
And it often excludes long-term conditions, doesn't it?
It does. Chronic conditions, conditions you had before you started the policy, or highly experimental treatments are often excluded. If you have an ongoing condition, PMI probably won't cover its routine management.
That deeper understanding is so important.
Yeah.
Now, let's briefly touch on business insurance. A lot of our listeners are entrepreneurs, small business owners.
Yeah.
What are the key policies they should think about?
For a small business, this is about securing their livelihood. The policies really depend on what the business does, but the common ones are employer's liability.
Which is legally required if you have staff.
Right. Then public liability if you deal with the public, and professional indemnity if you give advice or services.
And commercial property insurance if they have a physical space.
Exactly, which has different rules to standard household GI. Even if you're not an expert in commercial cover, just having a general awareness helps you spot the gaps and know when you need specialist advice.
That's great context. Finally, let's tackle a practical issue that undermines even the best plans. The auto-renewal trap. Why does convenience cost so much in the GI world?
It costs because insurers rely on our inertia. Premiums almost always increase year on year. That could be due to market trends, inflation and rebuilding costs, or just general claims increases.
And if you just let your policy auto-renew?
You are highly likely paying a loyalty penalty. You're accepting a higher price for the same or maybe even slightly worse coverage just for the convenience of not spending an hour shopping around.
So the message is clear. That annual review is non-negotiable. Don't just compare the premium, compare the quality of the cover you're getting for that price.
Exactly. It's about protecting yourself against market inefficiency, not just against a flood. It's a core part of cost-effective financial planning.
So let's bring this all together. How does general insurance slot into that overall holistic financial strategy?
GI is the first line of defense. It's the shock absorber. Think of it this way. Income protection and your retirement savings are there to grow and sustain your wealth over decades. GI is there to protect your current position from being wiped out in an instant.
So income protection handles long-term lost earnings, but home insurance handles the immediate cost of a fire.
That's it. Critical illness helps with recovery, but travel insurance covers the catastrophic bill from a foreign hospital right now. GI basically stabilizes the ground you stand on. It ensures your long-term plans don't have to be cashed in just to pay for a broken pipe or a car crash.
That makes its role crystal clear. It might lack the emotional weight of planning for, 30 years down the line, but it is the practical protective layer that allows everything else to function. The key is moving beyond just buying a policy to really understanding the principles, like indemnity, and avoiding the pitfalls of underinsurance and auto-renewal.
Pure loss prevention, all anchored by principle.
And that leads us to our final provocative thought for you today, rooted entirely in that concept of indemnity. If you approached every insurance purchase with the absolute certainty that the policy would only ever return you to exactly zero, that it would never allow you to profit, only prevent a loss, would you view the value of that protection differently? And would you therefore be more likely to dedicate the time and the money to purchase adequate coverage, knowing its sole purpose is just to keep you whole? Something to consider as you prepare for your next annual renewal.
An excellent thought experiment on the true meaning of risk transfer.
Thank you for joining us for this deep dive into general insurance. We'll see you next time.